Hello, I'm Shaun Richards of Not a Yes Man's Economics, and welcome to Lockdown London. Today, let me open with a bit of number crunching. One of the larger numbers we've come across in the credit crunch era, although it's also true we've become a bit anaesthetised to this sort of thing. Yesterday evening, the US Federal Reserve announced that in the quarter in which we're now in, March to June, it plans to borrow $3 trillion. There's a slight difference in the decimal places there, but it doesn't really matter because it's only an estimate anyway. And the number, if anything, looks like it will go higher. The 3 trillion is quite a large sum, and I want to give you a few perspectives on that. I'll look at the spending and behind it in a minute. But there was a time when people were very worried about the debt ceiling, wasn't there? That's gone on for a while. I was looking it up on their website. I think that's been raised over 60 times over the years. So there have been 60 big deals. If we switch now, though, to what it's costing America to borrow, we see that it has pretty much sailed through that announcement. Now, there's some element, of course, that people were expecting this, but it sailed through a phase where the extra spending by the US government has shot through the roof. For example, the benchmark or the international benchmark for these things, 10-year yield. Well, this morning it's 0.67% in the United States. So a little higher, but a very, very minor move. If we look at the long bond, 1.33%. So that's less than half what it was a year ago. So in fact, if you look at it just purely in those terms, the United States is choosing a really good time to borrow because it's cheap, very cheap. Why is that so? There's various influences here. One of the big factors, though, is the amount of bond buying we've seen from the US Federal Reserve. Now, it's winding that down at the moment. It's only buying $8 billion a day, and that provides a bit of food for thought, doesn't it, when you can say only in front of $8 billion. But it had been buying $75 billion a day at the peak of the pandemic crisis, so you can see that it scaled it down, but it's bought a large amount. Roughly over the last year, it's bought a bit less than $2 trillion US dollars. So we're seeing some extraordinary numbers here. And what we're seeing is something that I'm not sure through this phase was really expected, was such a shift towards central bank financing of a government. I've said before that I think this is implicit rather than explicit. What do I mean by that? In terms of actual monetization, then the government would issue a bond and the central bank buys it. I guess that's associated with Zimbabwe. I saw elements of that when I looked at Ghana a few years ago, also the Weimar Republic in Germany. So there's factors there. Moving on from that, we see that, in fact, the demand for cash or government spending seems to be heading, if anything, higher. We don't know, of course, the future as to where, for example, unemployment claims will go. But the initial jobless numbers we get each week kept shooting higher. The actual rolling number at the minute, as of the last update, is a bit below 18 million. That means a total number of 30 million new claims have come in over this phase. Some have come in, then gone out, just to explain the difference. So the pressure's on. Some more money has just been announced, has been expended on the paycheck program, a bit for small businesses, and so on. So there's an extraordinary amount of pressure here. But if we move to the bond yield situation and we look around, there are elements here that nobody cares. That won't remain true forever. But for the minute, I suppose we're what? In the eye of the storm when it's quiet. Thank you.